Welcome, everybody, to this episode of Conversations and Insights on de-risking banks through digital cooperation. I'll be discussing with Michal Cieplinski, who is a finance fintech veteran, I would say. He has a legal background, started his career at BNY Mellon, and he was part of Lending Club in the early days and part of the founding team of both Fundbox and Pipe. Welcome, Michal. It's fair to say that you wear three main hats: a banking hat, a compliance hat, and a fintech innovation hat. It's a great pleasure to have you with us to discuss this topic.
Effie, thank you. I was looking forward to it. I wear the fourth hat. How about the legal hat also?
The legal hat, it cuts across at least banking and compliance, right? And now it also cuts across the grown-up fintechs. And given what's happening in the US this year with the banking failures and now with all sorts of open banking troubles, I must say that the compliance and legal hat is pretty dominant and very much needed, right?
I think building anything in fintech, whether it's in the US, Europe, requires wearing many hats. You have to start with the following. It's a regulated field, which means you have to build within the framework that you're permitted to build with the protections that the regulations have provided to customers, whether they're business or consumers. So I think it's natural to be wearing many hats.
It's self-evident nowadays, but as we know, not to everybody. It wasn't like that 10 years ago. In any case, I wanted first to ask you about the recent banking failures, the Silicon Valley Bank, the Signature Bank, First Republic, all that debacle. And what are the learnings that you have taken from this, I would say, situation that unfolded fast, the speed of a domino, I would say, to say the least, and I'm not sure that we've seen the impact.
I think we haven't yet seen the end of it, but let's start with the reason for all of this. Banks are naturally hyper concentrated, either within their geographical area or within their sectoral area. We saw that with SVB, Signature was geographic actually, and with First Republic, FRB, which was sectoral and geographical as well. So what does it actually mean? Because we all say banks are concentrated, but we never really ask ourselves what it really means. It means that their risks are extremely concentrated to single triggers. They can be geographical or sectoral. So what happened with SVB can occur with pretty much any small and mid-sized bank because they're naturally concentrated within their area that they cover. SVB was startup venture ecosystem. As I said to my friends, it works perfectly until it doesn't. And the doesn't is always a cliff. And this is what we've seen here. A complete collapse and a cliff of over-concentration of the banking ecosystem.
So am I hearing you saying that this concentration is natural, or it's been like that traditionally? And especially in the US with the different states and because of the specific regulations that exist in the US?
Natural mean we take it for granted. We take it as, it's normal. Of course that they're natural. So US banking ecosystem is very different from the European one. We have top 20 banks. Most of them being, there are few, like 5 national banks, the rest 15 large regional banks. But the rest, 5,000 banks plus another 5,000 credit unions, over 10,000 institutions, are extremely regional. They're concentrated sometimes to a small city, to a small regional area, to one state. So it's natural that they are concentrated both on the depositor side and the borrower side within that area. It's just, but your question is it good? Well, that is, the answer to this is SBB. We took it for granted, and we are continuously taking us, well, this is the US banking system. But the reality of it is that we need to do something about this, because if SVB, which is a bank of a small sector of the US economy, venture capitalism is a tiny sector of the US economy, if that bank had to be rescued by the federal government, then it tells you that our systemic risk of systemically important financial services institutions go way beyond the large institutions. But every bank that services a certain area or certain state or leading bank in a state is a systemically important institution within that state and will require help if.
But what is interesting here is some would argue, oh, no, this was the crypto issue. But what I'm hearing from you is that you're arguing it can be concentration in the oil sector or it can be some specific agricultural sector. Is it
in a singular state? It really doesn't matter. I think it was concentrated within a certain economy, and as a result, the deposits grew and invested these and found itself on the wrong side of the trade, as we call it in the hedge fund industry. But the reality of it is that it can be a bank in Houston or Dallas that services the oil economy. It can be the agricultural bank from Utah. It's the same thing. It doesn't matter. Or the bank in Louisiana following hurricanes. It doesn't really matter what it is. It's just a natural thing for the bank to be that concentrated. And we are finding ourselves right now in a realization, what do we do about this?
And it doesn't loan participation, which to my knowledge and understanding is typical, is happening, especially for smaller banks, it is an option, a solution to be part of a loan participation. Doesn't that address the problem?
It does to a certain degree. So let's talk about what, maybe to your audience, what loan participations are. Loan participations allow Bank A to participate in loan issued by Bank B and hence diversify beyond its geographical or sectoral area. But the current state of loan participations, it's extremely manual. We're talking about 5 to 10 banks cooperating with each other on the basis of a one-pager and few economical data points. And as a result, in any case, it's limited to trusting the originating bank, chasing for manual updates each and every time. The interesting part, what I found, and I've been in fintech for 20 plus years, is that I started in hedge funds, and when you trade equities, you have a central clearing agency that's stock exchanges. You have bonds, you have exchanges plus several other venues. The interesting part is that there is no central clearing agency for loan participations. There are, effectively speaking, bank-to-bank interactions. But when you look at the volume, it's there isn't a bank that doesn't participate in loan participation, either selling or buying. It's one of the largest shadow trading that happens between banks because banks realize what I said at the beginning, which is they are extremely concentrated. And as a result, they need to diversify beyond their geographical or sectoral footprint. And the only way right now for banks to do this is invest in treasuries. But as we're seeing it, what happened with SVB, it's a very dangerous play. And also, it doesn't address the high interest rates that you need to provide to your borrowers on your savings accounts right now. So what you need to do, you need to find high yielding assets. That's loans. And you need to find them beyond your geographical sector footprint. The only way to do that is loan participations.
The idea of building a platform, the platform that you are just giving birth to, and briefly tell us the name and the mission, but where did the idea, or when or how did the idea first come to you?
So I've been in fintech for quite some time. I've been part of lending club, pipe, and throughout all of these nearly 20 years of my experience, I saw and I interacted with small and mid-sized banking industry and realized the one thing, how hyper local these institutions are. And which is natural when you talk to bankers, they say, of course, that's our premise. That's the uniqueness of the US banking economy, how hyper local they are. But I saw that all of their customers reside within a very small geographical footprint, typically 5 to 10 miles from their nearest branch. And what it means to be a customer, that means a borrower and the so because you have two customers, which means the following. These banks are extremely concentrated within the natural geographical area. If they're an inner city bank in Austin, they will do mortgages and commercial real estate. If they are in a heartland of America, they will do a lot of agricultural loans. If they're in another areas, they will do manufacturing loans. They will do shipping loans. It goes on and on and on, but they're extremely concentrated within these areas. And second thing, I saw having a technology background and launching fintech startups that are always technology based, I saw that the current tech ecosystem is completely not built for a cooperation between banks. So me being an entrepreneur and always trying to find the next thing to build, I realized, what about I build an operating system for banks that will allow them to seamlessly cooperate between each other and will allow them to use the loans and the deposits that they have to move them between themselves. In other words, one of my board members describes Capstack, so the entity that we're building out right now, as a SWIFT, but for assets and liabilities. We're building a platform that will allow banks to participate in each other's loans on a global basis, and will also allow them to move deposits to fund these loans. Because as there are banks that sit on a lot of deposits, there are banks that need deposits. There are banks that have a lot of loans. There are banks that seek loans. Capstack will be that central clearing agency to connect banks between each other.
The first thing I have to ask, do we have the technology to do this? Not only securely, of course, we need the security, but to break the silos, because that's really the big question. How do you break the silos amongst these banks? And will the banks embrace this? Will the banks embrace cooperation, or will they resist? Honestly, I've seen in the past tech companies try to solve problems in the bond market, which is an OTC market, right? And they haven't succeeded because of the resistance of those that are gatekeepers right now. Now, here we're not talking really about intermediaries and gatekeepers, but your customers, the banks, these regional banks, will they embrace? And what about the silos?
So 2 questions here. So let's
Yeah.
answer. The first question was, are there technology barriers for that? 5 years ago, I would have told you yes. Banks only in the last 3 to 5 years completed moves to more modern core platforms. For your listeners, cores are operating systems on the banks. Every single thing that you interact with a bank sits within the core, and then you add the layers to it, like online banking, card issuance, etc.
But are you talking about moving to the cloud, moving core banking?
Yeah, moving to more modern, exactly. There are significantly more modern offerings right now by the main players, the FIS, Pfizer, the Jack Henry, which are the 3 main players globally. They have modern APIs. You can move the data around for the first time. Second of your questions, would banks be willing to do that? The interesting part about this, I answered this question with a question. What is a bank? One $5 million loan at 10% yield, or 5 $1 million loans also at 10% yield? Of course, this. Diversification, diversification, diversification. There hasn't been yet a bank that returned my reach or the reach of folks at Capstack that said, I don't need diversification. Every bank seeks that. The question was, will the platform that you're going to build be compliant, will provide us with enough data to assess loans that we're willing to participate, and will provide us with the notions of a central clearing agency, which is moving the assets, moving the money, and then allowing us to view our participation in a seamless way, like as if you logged into your brokerage account and see your stocks and bond portfolio.
And their cash flows. And their cash
flows. Exactly. This is what is needed. It hasn't been built for a variety of reasons. Banks were in that transitional period. But 2, what happened with SV in the industry, in the banking industry, we all knew that something like this sooner or later will happen. The overconcentration, the lack of diversification was looming over the industry. And also, there's more banks in the US merging or closing than new banks opening. We used to have 8,000 banks. Now we're down to 4,800, 5,000, however you read this, plus the credit unions. But it's definitely shrinking. And I strongly believe, as a European, and looking at the economies in Europe versus in America, I think one of the ingenuities of the US economy, which we may not have always appreciated, is the diversity of its banking ecosystem. The typical bank that will provide you with a loan for your new restaurant, for your new plumbing service,
practice, whatever,
is typically your local bank that will understand the local economy, will know, is it needed in that little city or region that you're residing, versus this going to a central processing team located in a different state of a larger bank that doesn't know the local area. I think we underappreciate during the innovation that American banking system has brought in, which is a very diverse source of funding, of debt, that's extremely localized and understand local markets much better than a larger institution would ever do.
And I assume when you say banks, you're also including in those what I would call neobanks, the ones that can lend You're not excluding them from this.
No, of course. But the neobanks that are lending, there are not that many of them. Most of them just deal with the checking and savings accounts. And lending, I think fintech startups that engage in lending, like Fundbox, Funding Circle, and several others, do an amazing job because they also concentrated on a certain sector or a certain type of economy and cut down typically the costs that preclude banks issuing these loans. But all of this just speaks to the vibrant economy that we have here. Because the interesting part about this is people have various notions about money. But to every person that works at any of my company, I give them one book, which is Debt, the First 5,000 Years of Humanity. It's a very interesting, long 800 pages, so only for the most resilient ones. But it shows it's not so much money, but it's a concept of debt that moved us as a civilization. If you think about it, most of the wars were thought with the debt. Every company, we're right now on Zoom, well, venture capital, money, which is a type of a debt, from Google's to Apple's. I don't even can think of a company that reached very high levels of growth without debt. It's the debt that moves us as a civilization. And because
credit is the oil and continues to be, right? Unless we change completely our theories and our practice, credit is clearly what makes economies move. There's no doubt about that. We talk about data and so on, but it's credit, really.
It is.
Yeah, of course, can be made into data. And I guess that's one of the things that you're trying to do here with that. But is Capstack really a loan-to-loan marketplace from bank to bank? Is that the vision?
Well, the vision is an operating system that sits on top of the current banking operating systems and loan originating system. The vision for us is to allow banks to seamlessly invest in each other's assets, that's loans. It's seamlessly to move deposits between banks and also to offer each other services. The interesting part about the banking institution is that except for the top 20 banks, most of the banks no longer offer a full suite of services. We're talking about over 40,000 branches, 3+ million people employed. Capstack has the largest sales force in America to sell every insurance product, every type of a loan product, wealth management products. But most of the banks no longer do this, but they want to maintain the relationship with their clients. But there hasn't been a central service, a central operating system that will allow banks to cooperate with each other. We're not replacing the cores. FIS and Fiserv are doing an amazing job in maintaining banking operation. What Capstack is allowing is to cooperation between banks in a first bank-to-bank loan marketplace, because following the last 3 years, banks have an urgent need to diversify their portfolios. But then how you found new loans? There are banks there are what we call loan origination machines, originate great loans, well-performing loans, but very fast found themselves in a situation, I don't have enough deposits. I don't have enough means to fund those. And there are banks that sit on a large amount of deposits, but for a variety of reasons, they don't originate enough loans, enough diversification in loans will allow them to not only invest in those loans, but also fund those loans. And on top of it, a bank in Montana will be able to issue wealth management products on par with any larger bank or financial services institution, but it will be managed, underwritten by an institution that specializes in that wealth management. And why would Bank in Montana do it? Because it maintains the client relationship, provides the service that the customer needs.
Yeah.
So in principle, you can look at this as a SWIFT for assets and liabilities, or the largest financial services institution in the making.
I don't like, Michal, I don't like the SWIFT analogy, because SWIFT doesn't move assets.
I know, it's a messaging service.
Messaging
I know, yes. I get that. So for every listener, the analogy is not that correct. And as a person that grew up in Belgium, I know that very well. So SWIFT is a Belgian entity. It's actually a messaging service, but it clears the money, and then later on the money is moved. So think of Capstack as SWIFT plus the actual moving of the money. So not only we move the notion of an obligation to move assets and liabilities, but later on we also move the money.
Now, it seems to me that this is rather aligned with open banking and open finance, your vision, what you're trying to build. The question that I have is, first of all, if you agree with that, and then what is the opinion of the regulators? Because we haven't touched upon that. We didn't touch upon the fact that regulators weren't regulating so strictly and closely the smaller banks. And, there's a camp of people saying, oh, if we had been regulating these smaller banks, maybe we could have avoided it. But in general, the vision that you're trying to, the problem that you're trying to solve and the way you're trying to do it, are regulators going to approve?
So that's an interesting question, and I'll tell you the interesting answer to that. So two regulators, one state, one federal in the US, told me the following. So Capstack is a way for banks to diversify their portfolio and hence strengthen their balance sheets and strengthen the security of the depositors' money. So, and that's words of one regulator. I don't see a reason why we wouldn't be recommending it, if not in some situation requiring for banks to use. Because at the end, it is Capstack may become a pseudo-regulator or an effect of regulation, which will require banks to diversify their portfolios. What Capstack allows banks is to fully understand and underwrite the loans that they are investing in for the first time ever, because we're connecting banks' systems. We're allowing the participating bank to see the entirety of the underwriter's write-up, business projection, tax record, and also the performance of the bank. We are allowing for the participating banks in the bank-to-bank loan marketplace to make an informed decision as to whether to invest in these loans or not. But the regulators' approach to it was quite surprising. In when is it, in an answer, when will it be ready, and can we get a demo? And we already provided it to those two regulators. And the moment it becomes national, I think OCC will move towards recommending the solution to banks in need, because at the end, it does what the regulators' sole aim is, to maintain safety and security of the depositors, and by allowing the banks to diversify their portfolio so that no shocks to the system happen.
So basically, this digital tool can be used clearly for best practices. We could envision eventually to have some guidelines. What are the best practices in terms of different levels of diversification and better risk management? And of course, regulators would dream about reporting some of these KPIs.
Oh, yes. When the regulators saw our reporting tools, they were very excited. Let's put it that way. Because when you're a central clearing agency, this is natural for us that we will provide banks with the reporting tools. We will also provide banks with our analytics to show the banks, are you over concentrated in certain areas? Should you be buying other assets? There are other assets with these types of yield that are available. We are removing the geographical and sectoral boundaries that are now inherent in the banking ecosystem, but also adding unbiased analytics that will show banking executives, oh, now I can invest in a real estate in Boston area. I've never seen it. It's performing very well. Let me invest a little bit in it. And the Boston Bank can invest in my agricultural loans. This is what's going to be happening. We are allowing banks to diversify from their exposure and to build a proper portfolio, because as my background is in hedge funds, it's all about diversification. It's all about hedging risk management. And that ability to give it for the first time to banks, it's something that excites me every day.
And Michal, before we close, just to make sure, right now, as you said, if a bank in Montana has the opportunity to participate in a loan in real estate in the Boston area, okay, they can see the details of the loan, but they can't see the performance of the loan portfolio of that bank. They can't see other loans in that sector. They really can't get a picture to make some intelligent decision.
Or any intelligent decision. Like the current loan participation market is in the US, we call it the cottage industry. It's 5-10 banks together cooperating within each other. But the reality of it is that I would never invest in anything unless I know the past performance of the originating entity. Capstack will allow it. I will not invest in anything unless I can make an informed decision. Capstack puts participating banks in the shoes of the originating bank, providing all of the data that originating bank had, including their analysis. So what it does is a bank in Texas or Montana is not an expert in commercial real estate in Boston area, but guess what? A Boston bank is. A Boston bank provides the raw data plus its analysis of the performance, and hence allows the banks in Texas, Montana, California to make an informed decision. This is what Capstack is.
In that sense, you're building really a network amongst the banks that are 10,000 in the US. It could be in another region, and really providing them the tools to improve substantially their risk management capabilities and overall reduce systemic risks.
Exactly.
Wonderful discussing with you, Michal. We could discuss hours. This is risk management. A reminder too that fintech too is about risk management, because that is what finance at the end of the day is, whether it's done well with the customer experience, with economics, or whatever it is. Bottom line and core, it is about risk management. And let's not forget that every crisis originates from a liquidity problem. And here we are talking about having a dashboard like Star Trek. I like that analogy better than Swift, where you can see things and act accordingly.
Exactly. Having loans from other banks, having an ability to fund these loans, and having an ability before originating the loan, before issuing that loan, to actually pre-fund it by other banks. It opens up the spectrum almost inherently. What bankers, the CEOs and COOs of banks love, that I am removing any geographical or monetary constraints that the banks would have. And because I'm allowing banks to cooperate with each other for the first time. And I'm excited about this.
Very exciting. So before we close our discussion, Michal, a personal question. What is exciting you beyond what you're building? What are you reading and being inspired by?
No, what is exciting me, it's family, my wife and kids. It's something that is the reason I wake up every morning and seeing them happy. I have two amazing daughters and a wife that about 10 years ago I convinced her to lower her standards and marry me, and and continuously do that. And amazing about this. Funny enough, I was saying this thing that about this, and then I saw an interview with Charlie Munger. Apparently, he did the same thing about 50 years ago. He convinced his wife to lower her standard and continuously works on it. So yes, so on that and on the book, it's an interesting because I read a chapter of the same book every day. It's called The Daily Stoic. It's a book about Stoicism, but it's a book that every day reminds you of the lessons of Stoicism, which for me, and everybody picks it, you never become a Stoic, and you never become, it's a continuous work in progress, but it reminds, for me as an entrepreneur, it reminds me of the following. Out of all the things that are happening in the world and at your company, you have to clearly identify the things that you can affect any change versus the things that you can't. It's things that will happen irrespective of whatever you do. And the moment you realize that it's about 5% or less things you can actually affect change or you should be working on. The rest is the wheel of world, time, however you call it. And why is it important for an entrepreneur? It allows you to razor focus on the things that really matter and the things that you can affect change. A lot of people run around like I see it with the portfolio companies I personally invest in, run around like headless chickens. And I advise every single CEO and founder of this company, focus, razor focus. And part of that is figuring it out what I can control, what is the rest that at some point in the future I may be able to control, but right now at this point I can't. Focus, focus, focus.
Thank you, Michal.
Thank you very much, Eddie. It was a pleasure, as always.